Researching the stock market, are you? Well, search no more, you're in the right place. Welcome to the ultimate guide to the stock market rules, facts, and investment strategies. Whether you're just starting out or you've been trading for a while, this video is your one-stop shop for mastering the stock market. We're diving deep into the essentials, from fundamental rules to proven strategies that can help you build wealth over time. So, grab your notebooks, buckle up, and let's get started on this incredible journey to unlocking your financial potential in the stock market. Alright, before we get into strategies and rules, let's answer a fundamental question. What exactly is the stock market? It's like a giant online marketplace where you can buy and sell pieces of companies called stocks. Think of it like buying a tiny slice of your favorite pizza place, except instead of getting free pizza, you get the potential for your investment to grow as the company grows. The stock market is made up of exchanges like the New York Stock Exchange and the Nasdaq. It's a global hub where millions of transactions occur every single day. And just like any market, it operates on the basic principle of supply and demand. When more people want to buy a stock, the price goes up. When more people want to sell, the price goes down. The stock market isn't just some random game of chance. It's driven by real factors like company performance, industry trends, and economic conditions. It's about making informed decisions based on knowledge and strategy. Because when you approach the stock market with knowledge and a plan, you're no longer gambling, you're investing. Now let's talk about one of the most important concepts in investing: risk management. Even the smartest investors can't predict the future with certainty. The market can be unpredictable, and sometimes things happen that are outside of our control. That's where the 5% rule comes in. This rule is your safety net, your way of protecting your hard-earned money from unexpected market swings. It's simple. Never risk more than 5% of your total portfolio on any single trade. So if you've got $10,000 invested, you wouldn't put more than $500 into any single stock. It doesn't matter if your friend's cousin's brother told you it's a sure thing. Stick to the 5% rule. Protecting your capital is more important than chasing quick wins. The 5% rule is about long-term stability and growth. It's about weathering the inevitable storms that pop up in the market and coming out stronger on the other side. By limiting your risk with the 5% rule, you ensure that even if one investment goes south, it won't wipe out your entire portfolio. It's about staying in the game for the long haul. Alright, let's take a break from the rules and dive into some fun facts about the stock market. These tidbits are not just interesting, but can also give you a deeper appreciation of the market's rich history and its dynamic nature. These facts will give you a little bit of context and maybe even impress your friends at your next trivia night. So, let's get started. Fact number 1. The stock market is way older than you might think. It has a fascinating origin story that dates back centuries. The first official stock exchange was established in 1602 in Amsterdam with the Dutch East India Company. This was a groundbreaking development in the world of finance. That's over 400 years of history. Imagine the countless transactions and the evolution of trading practices over such a long period. Fact number 2. The New York Stock Exchange holds the title for the world's largest stock market by market capitalization. It's a powerhouse in the financial world. It's a testament to the sheer size and influence of the U.S. stock market on a global scale. The NYSE is a symbol of financial might and economic activity. Now, for fact number 3, let's address the elephant in the room: market crashes. Yep, they happen, and they can be quite dramatic. We've seen it time and time again throughout history, from the infamous crash of 1929 to the more recent financial crisis of 2008. These events have left a lasting impact on investors and the economy. These events are a stark reminder that the market can be volatile, and it's crucial to be prepared for the unexpected. Volatility is an inherent part of the stock market, but don't let this scare you off. The market's resilience is one of its most remarkable features. Remember, every crash has been followed by a recovery, and those who stay the course are often rewarded in the long run. Patience and perseverance are key. Fact number 4, did you know that over 70% of stock market trades are now executed by computers? This is a significant shift from the past. Algorithmic trading now dominates the market. These sophisticated algorithms can execute trades in milliseconds, far faster than any human could. It's a testament to how technology is rapidly transforming the world of finance. The future of trading is increasingly digital and automated. And finally, fact number 5, when it comes to the stock market, slow and steady wins the race. This age-old wisdom holds true even today. Historically, long-term investing has consistently outperformed savings accounts and other low-risk investments. The power of compounding and the growth potential of equities make a compelling case for long-term investment strategies. Now, I know a lot of you are probably thinking, this is all great, Kenton, but how do I actually get started? Where do I even begin? Where do I put my money? How do I make sure I'm making the right choices? So let's say you've got $10,000 ready to invest. It might seem like a lot, but with the right strategy, you can make it work for you. Here's a breakdown of how I would approach it. This is a method that has worked for many and can work for you too. Step 1. Diversify, diversify, diversify. This is crucial to managing risk. Don't put all your eggs in one basket. By spreading your investments, you protect yourself from market volatility. Spread your investments across different asset classes like stocks, bonds, real estate, and even alternative investments like cryptocurrency. This way, you're not overly reliant on one type of investment. Within stocks, consider investing in a mix of individual companies and ETFs. ETFs can offer you a diversified portfolio in a single investment. Step 2. Invest in what you know. This is a fundamental principle that can guide your investment decisions. Start by looking at companies and industries that you understand and believe in. This will give you confidence in your investments. Maybe you're passionate about technology, so you invest in tech giants like Apple, Amazon, or Microsoft. These companies are leaders in their field and have a track record of success. The key is to do your research, understand the business model, and make sure it aligns with your investment goals. Knowledge is power in the world of investing. Step 3. Consider adding some dividend stocks to your portfolio. These can provide a steady income stream. Dividends are like little bonuses that companies pay out to their shareholders. They can be a great way to generate passive income, and you can reinvest those dividends to buy even more shares, creating a snowball effect of compound growth over time. This is a powerful way to grow your wealth. Step 4. Embrace a strategy called dollar cost averaging. This is a disciplined approach to investing. Instead of trying to time the market, dollar cost averaging allows you to average out your purchase price over time and reduce your risk. It's a strategy that can help you stay consistent and avoid emotional investing. Now it's time to talk about the elephant in the room, the 90% rule. This rule states that roughly 90% of traders in the stock market actually lose money. Now I know that might sound discouraging, but it's important to understand why this happens so you can avoid becoming part of that statistic. The truth is, most people approach the stock market with the wrong mindset. They treat it like gambling, chasing quick riches, and making impulsive decisions based on emotion rather than logic. They hear a hot stock tip from their barber and dump their life savings into it without doing any research. But here's the thing. Successful investing is about discipline, patience, and a long-term perspective. It's about tuning out the noise, ignoring the hype, and sticking to your investment strategy. The 90% of traders who lose money often fall victim to common pitfalls like emotional trading, lack of diversification, and poor risk management. But the 10% who succeed, they approach the market with a level head. They're not trying to get rich quick, they're building a solid financial foundation for the future. Now, while this next rule might seem a little out of left field, trust me, it's just as important as any financial strategy. In fact, it might be the cornerstone of your success in the stock market. It's called the 1/3, 5/7 rule, and it's all about maximizing your learning efficiency. This rule is designed to help you retain information better and apply it more effectively. Becoming a successful investor is a continuous journey of learning and improvement. It's not just about making quick gains, but about building a solid foundation of knowledge. You're constantly absorbing new information, analyzing data, and adapting your strategies to the ever-changing market. This dynamic environment requires a flexible and well-informed approach. The 1/3 rule states that you should divide your study time into 3 equal parts. 1/3 for reading and absorbing new information, such as books, articles, and reports. 1/3 for actively practicing what you've learned, which could include paper trading, simulations, or real market investments, and 1/3 for reviewing and reinforcing the material. This could involve going over your notes, discussing concepts with peers, or teaching what you've learned to someone else. This approach ensures that you're not just passively consuming information, but also actively engaging with it and making it stick. Active engagement is key to deep understanding. The 5/7 rule is all about spaced repetition, which is a fancy way of saying, don't cram. This method leverages the brain's natural ability to retain information over time. Instead of trying to learn everything at once, spread your study sessions out over time. This helps to prevent burnout and keeps your mind fresh. The rule suggests studying for 5 consecutive days, followed by 2 days of review. This cycle helps to reinforce what you've learned and makes it easier to recall information when needed. This spaced repetition helps to solidify the information in your long-term memory. It's a proven technique used by top students and professionals alike. Instead of trying to cram everything about the stock market in one go, break it down into manageable chunks. This makes the learning process less overwhelming and more effective. Spend time reading books, articles, and financial statements. Diversify your sources to get a well-rounded understanding of the market. And most importantly, review what you've learned regularly to reinforce your understanding. Consistent review is the key to mastering complex subjects like the stock market. So there you have it, guys, your ultimate guide to navigating the stock market with confidence. By understanding key rules, diversifying your investments, and staying informed, you're already ahead of the game. Start small, keep learning, and watch your portfolio grow over time. Thanks for watching, and I'll see you in the next one.